Good evening, everyone. Hello, and welcome to our monthly webinar. My name is Justin Cooper. I'm a hard money lender and a full-time real estate investor and coach and consultant to other real estate investors. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now, I want to say thank you to everyone who made it to tonight's event. I know that you're giving up some of your time, so I will do my best to bring the value that you're hoping for. As you might know, tonight's webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors, and we are investors ourselves, so we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, tonight we are talking about the top 10-ish questions to be asking your hard money lender. I will be your presenter tonight. So if everybody out there can jump into maybe the questions section and just let me know that, yes, you can hear me, you heard my little spiel there, you can see my screen, jump into the questions section. That's where we'll be interacting if you guys have any questions. So dive on in, show me, a little, yes, I can hear you, something like that. Awesome, great, good news. Perfect. Well, as we are going, I call this the top 10-ish questions because there's really 10 big questions that we're going to be talking about, but there's a lot of smaller questions. So as you'll see kind of how I have it organized, and I'll have it organized a couple different ways. First off, the ones that I feel are important because having been a hard money lender for 9 years, 9 years now, I've come across a lot of questions from clients. And there's also a lot of questions I wish clients had asked. And so I put this together, hopefully asking and answering a lot of these questions for you. And then also in a specific order, because there's a lot of times we'll get on a call, we'll start chatting with someone, and then, 5, 10, maybe 15 minutes in, we realize that there was something that was a very, very simple and easy question that if we'd had asked first, would have saved both of us that same 5, 10, 15 minutes of our phone calls. So that's what we're going to be chatting about tonight. Before we get too far into that, I want to mention the Real Estate Investors Success Summits. If you live in Colorado, here in Denver, we have one coming up. And if you're in Minnesota, we've got our Minneapolis Real Estate Investors Success Summits coming up. We've booked the dates, we've booked the locations. So definitely mark your calendars. If you're in the Twin Cities, September 28th will be the all-day Real Estate Investors Success Summit. And if you're in Denver, October 12th, which is also a Saturday, will be the all-day Real Estate Investors Success Summit here in Denver, Colorado. So definitely put those on your calendars. Be looking for more announcements as we get closer as to speakers, the lineup, the times, and all that stuff, and certainly how to register for them. But I just want to get these out there since we have booked it. Get them on your calendar so you can make sure you're there and free on that Saturday. So a little bit about me, if you want to know. I started learning and educating myself probably around 2004. That's when I started going to these different gurus, going to the 3-day seminars, going to all that type of stuff and just learning about real estate investing. I actually bought my first flip in 2007, so over a decade now. Now that first flip for me was not profitable, but it was a massive learning experience. So, and I try to take all those lessons learned into every interaction that I have with my clients these days. Since then, I've become a full-time investor and hard money lender. I'd made that jump in 2011. Since then, I've done more flips successfully. I own a small portfolio of rentals. I've built new construction. I've used and have a self-directed IRA. I've bought notes. I've tried my hand at wholesaling, not necessarily successfully, but again, definitely have learned a lot through that. And then today, like I had mentioned earlier, I've been doing some consulting with investors. So if anybody needs some help getting their business going and getting started or just expanding it, happy to have conversations with you about that and see if maybe we're a good fit to work together. So Here are the questions. Yes, I will break these down, and yes, we will go over each one of these. So don't feel like you have to scramble right now to write these all down. But here's that order. And again, kind of in this order for a specific reason. So can you lend in this location? Are you a direct lender? How fast can you close? Can you lend to entities? How much will you lend? How long is the loan? What does a pre-approval look like? What does a full loan approval look like? What type of fees do you have? And then the last one, kind of the catch-all, what should I know that I did not already ask? So if we're ready, let's dive in. And of course, as we're going, if you have any questions, use that questions box, okay? Dive right in. Don't hesitate to ask. First, can you lend in X location? So like I mentioned, we lend in Colorado and in Minnesota. And so, but there's folks on this call, we have a national audience. We have meetup groups across the country. We've done business in other markets. And so just other people are drawn to Pine Financial. We have I think a pretty solid reputation and footprint on the internet. And so, um, And so we get calls all the time from people across the country. And sometimes we can weed them out because we see the area code. So we have an idea of if they're in, Colorado and Minnesota, or if they're in some other markets. So we can dive in and ask those questions sooner than later. But when you're reaching out to either Pine Financial or to any other hard money lender, I think this is one of the very first quick, easy, get it out of the way qualifying questions. So it's not a crucial question, but at the same time, this is really important for the time saving. So like I said, we lend in Colorado, we lend in Minnesota, and we're dabbling in Wisconsin. So if you have something in any of those three states, definitely be reaching out to us and let's see. Another qualifier is we don't necessarily lend across all of Colorado or across all of Minnesota. So just because you call up, hey, do you lend in Colorado? Yeah. Okay. Well, what about, say, Steamboat Springs, Colorado, right? A beautiful mountain town, great ski resorts. Um, do you lend up there? Well, we don't. Okay, well, that just saved us potentially a whole lot of time. So by diving deep into, can you even lend in this location? You know where you live, you know where you're looking to invest. If that's one of your first questions, you can probably sort through potentially a lot of hard money lenders somewhat quickly. Are you a direct lender? So this is something because you want to know who you're talking to. When you're calling up the hard money lender, are you talking to a decision maker? We hear about this all the time when you're going on those seller appointments, when you're trying to get in front of the homeowner and potentially solve their problem and buy their house, right? You want to be sitting at the kitchen table with the decision makers. Who owns the property? Who signed on the loan? Who can actually sell and sign a contract? Well, in a way, it's important to know that as well when you're talking to a lender. So often we hear about mortgage brokers. There's same is very true for hard money lenders. A lot of folks out there say they're hard money lenders, but really what they are is a broker. And there's nothing wrong with that. There's definitely a time and place to be a broker or to work with a broker because a broker will work with potentially several lenders. And so if you and your loan may not be a perfect fit for one specific lender, a broker may have another lender. So you still have one point of contact and still might be able to get your deal closed. But the other side of that is you're not necessarily talking to the decision maker. So sometimes when you have a more complicated deal, a more complicated issue with yourself in your qualifying, maybe it's a credit, maybe it's an income, maybe it's a experience thing, you may want to be dealing directly with the lender because again, that will be saving time. This may come up or you don't know. It may come up, but if you're dealing with a broker, sometimes they may have to collect all the documents from you before they turn it over to the lender that they're going to try and broker this to. And then that lender has to take a look at the file, probably go through all of it to say, okay, here's my questions, here's my concerns, here's why I can or cannot do it. So sometimes working with a direct lender will give you quick and easy access directly to that decision maker, and thus you'll have very quick answers as to whether or not you can do this project. So Pine Financial is a direct lender. We raise and lend our own money. We've got a couple mortgage funds. And so a lot of folks, even on this call potentially, are folks that have decided maybe I don't want to do fix and flips, maybe I don't want to own rentals. I just want to still invest in something that's backed by real estate. And so that is how we get the money that we lend out, is we raise that. And because that, we control the funds, and thus we make the decisions in-house. So when you call up with maybe an oddball project or something you feel is a little bit different, you can call up, we'll either answer you right away on the phone, or we'll hang up, have a quick discussion amongst ourselves, and then get right back to you. So there's certainly a lot of value in that, and of course, ultimately in understanding if you're talking to a decision maker. So here's one that comes up very often, it's especially important in today's market. How fast can you close? So when it comes to getting deals under contract, we know that time is of the essence, right? We have to be able to move fast, especially if we're going to try and compete against an all cash offer, let's say, because we all have this in our mind, a cash offer is the best offer. Closing quick is super important. Now that may or may not be true depending on who your seller is and what their situation is, especially if you're marketing to off-market deals. Maybe they need time to move, maybe they need time to find a new place, whatever the case may be. But regardless, if you know how fast you can close, and of course how fast your lender can get you closed, then you can go in and make a strong offer and be confident in the type of offer you're making. If you don't know how fast your lender can get to closing, you want to be competitive in your offers. So you say, we can do a 7-day close, but you're talking to your lender and they say, well, because of this, we're going to need an appraisal. We're going to have to do this. We're going to have to do that. We probably can't close for 3 weeks. Well, now you may have just gotten yourself in trouble. Your earnest money might be at risk. You may have to be negotiating extensions. You may be trying to put a lot of pressure on your lender that in situations that they just can't get around. So understanding how fast your lender can close is going to be really important, because it's going to allow you to go out and make more confident and stronger offers, knowing exactly how you should be approaching them. So at Pine Financial, we can close quick. So we've got 2 main loans, and I'll be touching on these a little bit in the presentation. We've got our rehab loan, where we're going to lend potentially 100% of your costs. But with that rehab loan, what we're going to do there is get an appraisal. So appraisals can slow things down a little bit. And then our other loan is our acquisition loan. And with our acquisition loan, we do not need an appraisal, so we can move a little faster. So with the rehab loan and the required appraisal, probably 2 weeks is fair, depending on several moving parts, but 2 weeks is probably fair for the rehab loan. And then the acquisition loan, we can move faster because we don't have to have that appraisal. So maybe a week or less. Can you lend to entities? Being real estate investors, sometimes we like to protect our assets. And one of the easy ways that we can do that is through having an entity. Now, another easy way, of course, is insurance, but we're not really talking about that tonight. So if you want to be buying or investing in an LLC, let's say, it would be important to know if your lender can lend to an LLC. If you're calling your lender and you're already under contract and you made the offer as your LLC is buying the property, then you want to make sure you're working with a lender who can lend to your LLC. Of course, the other way is true as well. Some hard money lenders will require you to invest and buy, and will only lend to an entity. They'll only lend to an entity, because a lot of hard money lenders will only lend on investment properties. And one of the clear ways to say that this is not an owner-occupied property, it's actually an investment property, is to be making a loan to an entity, right? And so they may require you to do that. So understanding both sides of that coin. Can they lend to entities, but can they also lend to you personally? Sometimes when we're buying rental properties, we may want to be buying in our personal name, because what we can do is go to the hard money lender, borrow the purchase price, maybe borrow the repair money, maybe even the closing costs, potentially 100% of the deal. And then provided those repairs will increase the equity in the property, we can then refinance that property to keep it as a rental, refinance it out of the hard money into the long-term conventional loan, and then you're off to the races, right? Hopefully having little to no money into the deal. That's one of the amazing strategies, buying rentals with hard money. But typically those refinance lenders will only lend to you in your personal name, even though yes, it is an investment property. They will not be able to lend to an entity. So in that case, it might be important to to make the offer and to buy in your personal name. and thus have your hard money lender lend to you personally so that the refinance goes nice and smooth. All right, so now that we've got a lot of the higher level, really quick questions out of the way, now we're going to dive into a little bit more of the nuts and bolts of how do the loans work, right? So if you spend a quick minute or two asking those quick questions, you're going to be finding out, can they lend where my deal is? Can they loan to my entity? How fast can we move to make sure my offer matches up, or I can make an offer that matches up with what my lender can do. But now we're going to start diving into what does a loan actually look like. And so one of the big things we talk about is how much will the hard money lender lend on a property? Oh, sorry. Let's go back. Can you lend on entities? Back to what Pine Financial can do. We can lend to both. We can lend to you personally, and we can lend to an entity. Okay, sorry about that. So how much can you lend on the property? Now this takes several different forms, right? And so this is now into where I call it the 10-ish questions, because this is question number 5, but there's a lot of follow-up questions, a lot more detail type questions here. So how much will you lend on the property? Now your lender will probably say something along the lines of an LTV, and I think I already mentioned that. So for our rehab loan, we will lend up to 70% of the after repair value. And if I didn't mention it, well, there you go. So 70% of the ARV. So that's our loan to value. Other times, they may just say how much dollars they have available, or how much, what's their maximum loan amount. Lots of different variables. But once they say whatever their standard short answer is, this is where you really have to start diving in and understand more of the nuances of what they're really talking about. So if somebody just said, you ask a hard money lender, how much can you loan? They say 70%. That's great. So that's our first question. What LTV will you lend up to? What loan to value will you lend up to? But then once you know that, now what is that value? What's the V? So is it based on the after repair value, the ARV, after repair value? So on a fix and flip, the ARV would be what is a property worth after it's all fixed up and beautiful. Is that LTV based on the as is value? Or are we just looking at the potentially ugly beat up property? And what is that ugly beat up property worth today? And they'll loan 70% of that. Are they looking at the purchase price? We'll loan a percentage of the purchase price. So understanding not just what the LTV is, but what the value that LTV is based on can be really important. So once you know, is it the ARV, is it the as is? Now, obviously the purchase price is what it is. And we know that because of the contract that you and the seller have signed. But if the value is the ARV or the as is, well, how is that calculated? So for us, if we're going to lend based on the ARV with our rehab loan, we're going to order an appraisal. And we're going to order that to confirm, right, a third-party value. Not my opinion, not necessarily your opinion, but let's get a third-party professional's value. So, okay, and that kind of goes back to how long does it take to do this? Okay, so see how these questions start circling in. Sometimes you may answer one of these questions in one of the other questions, before you even get this far down. Okay, so we know that what the LTV is. We know what that LTV is based on. Okay, but now what do we get with that? So does that include repairs? If we're going to be doing fix and flips, or we're going to do value add rental properties, we're going to be wanting to fix up the property. And one of the huge value adds of hard money lenders is that they will lend, or a lot of them will lend the repair money. So that's got to be a good question. Does that include the repairs? So yes, no, great, we start working through that. And if they say yes, then here's the follow-up question. Will there be a draw process for the repairs? So some lenders may just say, if your repair budget is 50 grand, some may just say, here you go, here's 50 grand, pat you on the back, wish you good luck. Others may say, okay, I've got 50,000 for you, but I'm not going to give it to you until all the work is done. Show me that the work is done, show me that you paid for it, and then I'll reimburse you. And then of course, there's probably tons of different hybrids in between that. Okay, so maybe they'll give you some upfront, maybe they wait till some of the work is done, maybe they'll pay the invoices that come in, maybe they'll reimburse you for invoices that you have already paid. So at Pine Financial, what we'll do is we'll actually divide that repair budget up, probably no less than 4 draws, but depending on the size of the budget, if it's $100,000, there may be 8, 9, 10 draws. And each draw is based on a percentage of completion. So each draw would be the same size. And then, one of the extra things that we do is we'll typically give the first draw at closing. So no work has been done, but yet you're walking away from closing with a little bit of money. So you can use that. It goes to the investor, not to a contractor. And so you can use that to pay for some demo, to order cabinets, right? Whatever you want, it goes to the investor. But understanding this repair process can be really important. And so I would highly encourage you, if they will give you some repairs and if there is a draw process, to spend a lot of time digging in to how that draw process will work. Because this is one of the things that I see makes and breaks timelines on projects. If you're not properly accounting for how the work will get done and how your contractors will get paid, things can slow down. You can get tripped up. People will be saying, I got to get paid. I can't come back until you back to your project until you pay this invoice. But you're sitting there saying, hey, Mr. and Mrs. Lender, I need more money to keep my guys going. But the lender is saying, hey, you didn't check the boxes. You're not at the next step to qualify for that. So it's really important to dig in. This is one of the most important things I see that people miss, is that they don't spend enough time understanding the repair draw process. Really, really important. If you're borrowing repairs, you have to understand how you're going to get access to that money. So a lot of these lenders out there, including Pine Financial, that says we are 100% lenders, the next question is going to be important, because does that include closing costs? If somebody can cover 100% of the purchase and 100% of the repairs, that sounds great, but that doesn't mean that it's no money down, because there's going to be closing costs. So closing costs are going to be the title company, their recording fees, their courier fees, all those other things, right? All the diligence that title companies do for us. There's going to be insurance that is probably paid upfront at closing. So that's part of your closing costs. And then always lenders like to put some fees at closing, right? Whether it's some prepaid interest, maybe it's some points, maybe it's processing and underwriting fees. Those are going to be closing costs. So it's important to understand that whether or not you can roll the closing costs into the loan. Okay. And now there's a few other moving parts there. If someone says they're 100% lender, meaning purchase, repairs, and closing costs, which sounds great, but are they maxed out at a certain LTV, loan to value? So what we say at Pine Financial, we're 100% lender up to 100% of costs, up to 70% of the after repair value. So what does that really mean? In practice, it sounds good, but what does it really mean? It means if your purchase, repairs, and closing costs are over 70%, for us, it means we'll probably still do the deal, but you would have to bring that difference. If your purchase, repairs, and closing costs comes in at, say, 73% of the ARV, we would fund the 70, and you would have to bring that difference of 3%. So spend some time, again, going through that. Okay, let's use a scenario. Show me the last deal you funded and how those numbers worked roughly. Or if you're looking at one, dive a little deeper into how those numbers will actually play out with your hard money lender. And then, of course, do you have any minimum or maximum loans? So we've done some deals over the years. We've been around for over 10 years now, where the price points were extremely low. And so would we even go that small? Now, that to some folks may sound a little silly, but if your lender gets paid in points, let's say, and 1 point is 1% of the loan amount, and your loan amount is incredibly small, then what they're going to make in dollars will be very small. And so sometimes lenders feel like, well, that deal is just too small. It's not worth my time and effort to do that. Although it takes as much work to close a $100,000 loan as sometimes it takes to close $1 million loan. So there may be minimums involved in there. On the other side, there might be maximums. So maybe your lender only has $1 million to play with. Maybe they're just not comfortable playing in the $1 million price points. So understanding that up front, if you love the $1 million price points, but your lender is not able to do that for whatever reason, it's important to know that up front, again, so you're not going through the whole process assuming that you have this lender lined up when on day one after you go under contract, it turns out they actually can't move forward and fund you. So it's important to understand those things. So for Pine Financial, we don't have a minimum and we don't really have a maximum. So the minimum for us, if a deal generally falls where the loan amount is under $50,000, then what we'll do is we'll go more to a flat fee than to the from and move away from the points. And then if you are looking at large deals, we are very comfortable in that $1 million price point, depending on what market you're in, depending on what you're doing. We fund some new construction projects that have ARVs, in 2 million plus. We've funded some, townhome developments that are several $1 million, and we've been getting more into the commercial real estate where, 3, 4, $5 million loan amounts. And so it really kind of at that point falls back to say, would you qualify for this size loan? Are you comfortable and experienced in that size loan? Generally speaking, Pine Financial can play in all those different price points, but it's certainly worth picking up the phone if you're not sure if you would qualify, if you're not sure if you could handle it, or if you're not sure your lender can do it. It's always worth a quick phone call and ask these quick questions. So how long is the loan? So this is, I think, a pretty important question, because you have to understand not just how fast do I plan on moving, how fast does my contractor say they can get it done, how long does a property have to sit on the market before I can get an offer, but just how much time do I have to get the deal done before my lender comes knocking wanting their money back. So it's important to understand that. So generally in hard money, we're talking about months, not years. So for Pine Financial, our loans are 9 months long. And sometimes on our new construction projects, they might be 12 months long. And it's important to understand those different moving parts, because last thing you want is to be inching your way through. You've got a buyer on the line and everything's looking good, but you're not set to close until month 10, right? You don't want to get into a disagreement with your lender at that point where you're so close to the finish line. So just understanding that, and then of course staying in constant communication with your hard money lender, I think can be really important. It just sets everybody at ease. The more you talk to them, the more they talk to you. Generally, hard money lenders love real estate, and they're investors themselves. So they get excited when their clients are doing well, and they may also have a ton of advice when it comes to projects that aren't going well. So some follow-up questions, once you know how long the loan is, well, what if I need more time, right? Just like I was saying, what if you've got a buyer on the hook, but it's not going to close till month 10? What do we do? Well, most hard money lenders probably have an extension. Pine Financial certainly does. But what makes it easier to get an extension? If you've been in conversations throughout the project and everybody's on good terms, you've been making your payments on time, you're letting them know about the progress, you're letting them know about the hurdles and the issues you've been having. Hey Justin, I had this contractor and he walked off the job, and it took me 2 weeks before I found somebody who was willing to come in. But once they did, they found that my first contractor did a bunch of things wrong. So now they got to go back in. It's going to cost me more money. It's going to cost me more time to fix these things. So and that may be a conversation in month 2. We don't have to be waiting until month 7, 8, or 8 to be having that, but just letting us know how your project's going and talking to us can be really important, because you never know, maybe it does get to that month 6, month 9. And that way we've been talking, and it's a lot easier to get those extensions done. Now, on the other side, what if your contractor moves as quickly as they actually said they would? What if the market responds really well because you put out a great product, a great looking house, you priced it fair, and now you've got a contract in, say, 3 months, they're set to close at the end of month 4. Well, you've got a 9-month loan potentially. So what happens? Do you have to owe 9 months of payments? Do you have to pay all this extra interest for time you didn't even have the loan? Are there just some penalties? Maybe not the full interest, but are there just some penalties for paying them off early? Understanding that can be really important as well. So Pine Financial, no, we don't have any prepayment penalties. I think a lot of hard money lenders out there these days do not have prepayment penalties, but it's really important to understand that, again, so you can plan for it. If your project is going to move really quick and smooth, it's a really light cosmetic rehab on a condo. And so it's going to go quick, and it's a highly desirable neighborhood, and it's going to go quick. But your hard money lender that you're talking to says there's a minimum of 6 months of payments. Well, maybe you want to shop around for a different lender, because you don't want to have to pay 6 months of payments when you'll be in and out closing to closing in just 3. So understanding all those moving parts, not just how long it is, but what happens if I need more time, and of course, what happens if I'm done in less time. So what does the pre-approval process look like? So ideally, I like to talk to my clients before they've made an offer, certainly before they've gone under contract. Now, that's not a deal killer. If you call me tomorrow morning and say, hey, Justin, I just went under contract on something, let's get going. That's great. I'm in. Let's go. Let's start diving into the numbers and everything else we need to do. But by coming in and getting pre-approved, what we're doing here is lining up all these questions, making sure you have the right lender in place. We're making sure you know the minimums, the maximums, and of course, what you can qualify for, how that loan will work. You're preparing for your scope of work and your draw schedules, and you're discussing with your contractors, lining them up appropriately so they know how they're going to get paid, and your conversations as the investor with the contractor line up. All these things are going to be really important, and a lot of them can be worked through and discussed pretty quickly by getting pre-approved with a hard money lender. So what does that process look like? Is there an application? Is there a face-to-face meeting? Do I need to deliver a bunch of documents? Do we have to walk a certain number of properties? Do we have to crunch numbers on a deal? Are there certain forms that need filled out? What does it look like to get pre-approved? So for Pine Financial, all we need is an application. You can find it online on our website, pinefinancialgroup.com, or you can call us or drop us an email. Say, hey, Justin, I heard you on the webinar last night. Love to start getting pre-approved with you. Here's my email address. Great, we can do that. Now, once you get pre-approved, how fast can you get a lender letter, a pre-approval letter? So this is also just how long does the process take? Obviously, if it's just a quick application, then it should go pretty quickly. You get the application, the lender will review it, say, yes, you're approved. Awesome, let's move forward. But if there's a bunch of documents and stuff, then maybe there's going to be a longer review process of those documents. Maybe they're not going to start that review process until they have all the documents in front of them, and then they start the review process. So understanding what kind of documents they will need and require, well, then you'll be able to piece together and ask, how long does the whole process take? And then once pre-approved, can you get a lender letter? And a lender letter, a pre-approval letter, of course, can be used to make your offers look stronger. You know how fast you can close, you know how much money you can be borrowing, and then you can also present a letter that says, hey, here's a lender who backs up everything I'm saying I can do in this offer. So it can be pretty powerful, especially if you're working with a good local lender. Then typically the good real estate agents will recognize that company. Maybe they've already done business. So when you send somebody a pre-approval letter from Pine Financial, a lot of agents in town know Pine Financial and have done business with us. So that will help make your offer look better. Another thing is if they don't know who, say, Pine Financial or another lender is, it has their contact info. And so if you make an offer saying, hey, I can close in 2 weeks, sometimes real estate agents don't believe you. And so they may want to talk to your lender and say, hey, I just got this offer from Justin Cooper. He says he can close in 14 days. Can you do that? And then, I, as the lender, would answer, yeah, and we'll have a conversation about what we do, how it works, have I pre-approved them, and how comfortable are we with that? We can have a brief conversation to, again, using your lender to help you get a deal under contract. So having a lender letter can be really powerful for several of those reasons. So now, is there a fee to get pre-approved? Now, that's a really good question. Most, again, hard money lenders that I know of do not charge a fee, but some certainly do. Pine Financial does not. So it's important to understand that, because if you want to go talking to every hard money lender and getting pre-approved with everybody, that's fine, right? It just takes some time to do it. But if there's fees associated with some of these, that can really start adding up. So understanding that, maybe that's all you have in your area. Everybody charges fees. Okay, well, at least you know that because you made some phone calls and you've asked those questions. And now you can go back and instead of shelling out $20, $50, $100 per application, you can pick and choose based on questions just like this and say, okay, I have to pay a fee because everybody I've talked to charges a fee, but here's the ones I really like. So you can be much more selective when it comes to that. And of course, how long does it take to get pre-approved? So for us, you could literally send me an email tonight or find the application tonight and online, send it to me tonight, and tomorrow you'll have a pre-approval letter in hand, provided you're pre-approved and you want a letter. So for Pine Financial, we like to move really quick. Basically at every step of the way, Pine Financial does not want to be the one slowing down the process. So we like to move really quick, make quick decisions, and hopefully that will benefit you as the investor. But it's also important to know that, because if you're planning on making an offer, your agent may want you to have a pre-approval letter before they'll actually submit the offer, sometimes they want you to be pre-approved before they'll take you out and show you a property. And if you have a property that you really want to go look at, but it turns out because of the documents that you need to provide, because of the time to review those just for a pre-approval, maybe that takes 3-4 days. Well, now maybe you've missed the opportunity that was in front of you. So it's important to start the process sooner than later, in my opinion, and then fully understand that. And of course, how long it takes to get pre-approved and what the timelines are for each step can be really important. So what does a full loan approval look like? So of course, the full loan approval is different from a pre-approval, because now we're actually under contract on a deal. We're actually moving forward with diligence on the actual property. So uh, what does it look like? Well, like I was mentioning on our rehab loan, we need an appraisal. So understanding um, the different steps that are associated with the full approval. So for us, the rehab loan, there's an appraisal. For the acquisition loan, there is not, but we still want to get comfortable with that after repair value. So what does that look like, and how long does it take the lender? What are the different documents that you need to provide? So does the lender look at your credit? And then what are they looking at on your credit? Are they looking at the credit score? Are they looking at the credit report? Is there something specific they're looking for? Something that may be on there that would then automatically disqualify you? Understanding what the lender looks like, so you can either address that up front or you can find ways around that. Do I need to have reserves? Reserves is liquidity, is money in the bank. How much money do I have to have? Even these lenders who will do 100% financing still may require you to have some money in the bank. Do I need to have income? So income, is that coming from a W-2 job and a pay stub? Are we looking at taxes? Do they qualify a DTI, a debt to income ratio? What does that look like? Do I need experience, right? All of these things are going to be important to understand. Now, a lot of these can be figured out and discussed and planned for at the pre-approval stage, but understanding once you go under contract, things are going to start moving quickly, right? We're using hard money because hard money lenders can move quick. And so we want to make sure that we have the documents ready when we're applying for that loan, whether it be at the pre-approval or we're under contract and getting the full approval. So again, backing up to what does Pine Financial look at? Well, we do look at credit, but what we're looking at there is more on the credit report, not necessarily the credit score. So we've made loans to folks with very low credit scores, but we're digging into why. So are there bankruptcies, foreclosures, short sales, things like that? We might be okay with that. In fact, we are often, but we want to know what happened and why did you get into that situation. Big red flags for us might be tax liens if you're not paying your taxes, judgments, things that could attach to the property and put all of us at risk. So that's what we're kind of looking at on the credit. Reserves, yeah, I want to make sure you have some money in the bank. I keep saying it that the rehab loan, we can lend potentially up to 100% of the deal. So purchase, price, repairs, even the closing costs, right? So you could literally have no money out of pocket at closing. But over the past 1,500 deals that we've done, we know that not every deal goes smooth. And typically when things don't go smooth, that means it's costing you money, whether it be just longer holding time. And so your monthly payments, there's more monthly payments, whether it be like I had mentioned in that other example, your contractor skips out on you and now it costs more money to fix the problems. Maybe there's just normal unknowns. You're planning on just going in and changing the outlets and the electrical outlets and the electrical plates and switches. And then you buy the property, you get in there and your electrician starts doing it and says, oh, actually, we've got some other issues here. We need to rewire the whole house. So your $500 line item just turned into a $5,000 line item. Okay, I mean that happens so often, not necessarily in electrical, but across the board, these unknowns pop up and they all cost money. So we want to make sure you have some money. So for Pine Financial, we want to make sure you have at least $10,000 or 7.5% of the loan amount, whichever's higher. Do I need to have income? So for Pine Financial, no, you don't necessarily have to have income. That's for us is kind of like the backstop, right? If you're tight on your reserves, if there's a few questionable credit issues, if the deal isn't a slam dunk home run, well, what happens if a couple of these, worst case scenarios come together? What if two of them, three of them come together? Do you have additional income, something else to make sure that you'll still be able to get through the project? Last thing we want to do is set our clients up to fail. But no, you don't have to have income. We deal with clients all the time who are self-employed, and because they own a bunch of rental properties or whatever else, they're able to write off a lot of expenses, and sometimes they don't show a lot of income, and that's potentially okay. But we're looking at the bigger picture. Are we setting our clients up to fail? And along those lines, do we need experience? If one thing experience tells you, a lot of things will change on your projects and you will most likely go over budget. So knowing that, how do you handle these things when they happen? Who on your team, if you don't have any experience, that's not a deal killer, at least not for Pine Financial, but who do you have on your team? Who do you have in your corner that can help you out? If you're asking questions, should I open up this wall or not? Who has experience with that? Hey, my plumber found an issue with the sewer line. What's a quick way to get around that or to remedy that, right? Understanding that all the different moving parts and having, if not you having the experience, somebody on your team that you can call. So we like to see like a local mentor or maybe a really experienced real estate agent. Maybe if your brother has done fix and flips, something like that, somebody that you can turn to and ask these questions when they come up. So what types of fees do you charge? Question number 9. This is like the last question basically in this list is what fees do you charge? Now I got to be honest, when I'm talking to clients, which is all day, every day, and they're calling in saying, hey, I'm interested in a hard money loan, what do you charge? That's almost the very first question they ask. But I put it here at the end because ultimately, if you find a hard money lender who has the money that you need, who can structure it with a loan to value and repair funds and stuff in the way you need it, if they're able to close as fast as you need it, if they're able to support you by talking to your real estate agent, providing pre-approval letters and all things like that, at a certain level, what they charge doesn't matter because the financing is a means to the end. If you're able to now do the deal that you're trying to do because you found the right hard money lender and they're structuring the deal in the best way for you and your business, that's almost more important than what they charge. Not to say it's not important to understand what they charge, because ultimately you need to be figuring in on your overall profitability. Should I be doing this project? What purchase price should I be offering? You need to understand those fees so that you can build those in and properly analyze your deals, both up front and then of course at the end when you're really figuring out your profitability, especially if you're splitting profits with partners and stuff. But understanding what do they charge. So what I found is typically hard money lenders will talk about two things. They talk about points and they talk about interest. And so points, that's what lenders will charge in origination. It's what we charge to make the loan. And so to do that, we charge points. And 1 point is 1% of the loan amount. So if somebody says they charge 4 points, then that means they charge 4% of the loan amount in origination fees. And then interest, typically hard money loans are interest only. And which means it's a lot easier to calculate. We're not looking at amortization schedules or anything like that. If they charge 15% interest, then you take the loan amount times 15%, and that'll give you your annual interest amount. And then you would divide that by 12 for 12 months, and that'll tell you what your monthly payment would be. So understanding those two things, those are the two biggest fees that they charge. But when you follow that up, because that's probably what they're going to say when you say, what types of fees do you charge? What does it cost? They're going to say points and interest. And then the follow-up question would be, is that all of them? Because most likely there's going to be some other fees. So as an example, Pine Financial has a processing and underwriting fee of $685. That is part of those closing costs that, depending on the loan and how good of a deal, will be rolled into the loan. but it's important to know that so you're not surprised when you get to the closing table. We charge a draw inspection fee, $100 per draw inspection. So again, understanding that. And for Pine Financial, we charge that up front. That way we calculated roughly, here's how the draws will work, right? We had this conversation already. Here's how the draws will work. Here's how many you should have. Here's what we charge. And then so again, at closing, we charge all those up front. That way we're not nickeling and diming and going back and forth in the middle of the project. You're just focused on getting the deal done at that point. But so we charge a deal review fee. I'm sorry, we do not charge a deal review fee. It's a draw inspection fee. Are there any upfront fees? So this is a big red flag when I see people talking online in different forums. This is always everybody points out upfront fees as a big red flag. And I don't know any hard money lenders who charge them. I know there certainly are ones that will or try to. The only thing that Pine Financial would charge upfront would be for the appraisal. And of course, that's not money coming to us. That's not a profit center for us. That's simply a third-party professional doing their job, and thus they should be paid for it. And the appraisal is done before closing, and thus the appraisal gets paid before closing. Otherwise, everything else that we charge is at closing. But understanding that as well, this could be another one of those points that weed people out. Right? Is there an application fee? Are there any other upfront fees? Are there deal review fees? Things like that, and understanding that you may be out hundreds, if not thousands of dollars before you even know if you can get a loan with a lender. And so that might be a red flag, something to think about as you're talking to lenders. And so number 10, what should I know that I did not already ask? Now, I don't have any follow-up questions on this. I don't have any other points because I put together the list, and I think I did a pretty comprehensive list based on the experience that I've had over the past 8-9 years as a lender. But depending on how the conversation goes, depending on who you're talking to, there could easily be, this is something that you should ask your lender, because just the natural progression of the conversation, you may or may not just follow a hard script and ask these questions and check these boxes. It may just flow naturally in the conversation. And so there may be something that the lender really wants to make sure you understand about their loan, but you didn't ask a specific question and the conversation didn't flow to where they could properly describe that. So I think I had mentioned this when we're talking about the repairs and the repair draws. For me, this is something I always try and circle back to because I think it's really important for people to understand. And a lot of times they don't ask. So I get really excited when somebody actually asks this, what should I know that I did not already ask? And even if they don't ask it, sometimes I'll try and circle back and say, hey, just before we get off the phone, I want to make sure you really understand this point. And I take the conversation back there. So this is an opportunity for you as the investor to circle back and really try and get to know what differentiates the hard money lender, what is important to them, what do they think you should know? Because if they think you should know something, it's probably important that you know it, whether about investing in real estate, about the deal you're looking at, or about their loan in particular. So that is the 10-ish questions. Now, I've mentioned a lot about what Pine Financial does, but I didn't have it on any of the slides. So I just want to quickly go over our two main loans. These are a lot of the bullet points that, will directly answer a lot of those questions that we went over. And so here's our acquisition loan. So this is that 90% of purchase price. This is the one where we do not need an appraisal. So we call it our acquisition loan, and we will lend 90% of the purchase price. We do check credit. Like I said, again, we're looking more at the report than the score. The down payment is sourced. So what I'm talking about there is your reserves, your liquidity. I want to see one bank statement, and I want to make sure that that bank statement shows that you have at least that 10% down. And of course, those closing costs that would come at closing. I do document income. Again, one pay stub, 1 year of taxes, whatever that may look like. I just want to take a look at those. We can close fast in days, not weeks, again, because we don't have to order an appraisal on this one. We can close in the name of an entity or in your personal name. And again, it's a 9-month balloon. And then our rehab loan, this is where we'll do 100% of costs, purchase, repairs, and closing costs, up to 70% of the after repair value. Again, we look at credit, report, not necessarily the score. The reserves, I want to make sure we have at least 7.5% of the loan amount. Again, just send me one bank statement or statements if you have, multiple accounts like a checking account and a savings account. We do take a quick look at your income. Still fast closings, 2 weeks, even though we do have to get an appraisal. And again, we can close in the name of an entity or your personal name. And again, it is a 9-month loan. So with that, thank you for hanging in there and bearing with me as we got through what I think are the 10-ish most important questions to be asking your hard money lender. Hopefully you won't have to be asking any hard money lenders because you're in the markets that Pine Financial lends on, and I gave you all the answers already. And so hopefully you'll just be flooding me with applications and we'll be doing a lot of business together. But that being said, I see that there's a few little questions in here that I might focus on and try and get answered. But if there's anything else, I'd love to chat with you some more. Please dive into that question section. We definitely have a few minutes here before our standard 1 hour time is up. So let's take a look at the questions, and hopefully somebody will be sending some more questions in. Yeah, so one of the questions, now this goes back to the beginning, in the faster non-rehab loans, the acquisition loan, what's the max loan to value? So that's interesting. So we don't necessarily have a loan to value qualification there. We are lending based on the purchase price, right? 90% of the purchase price. But we do take a look at the after repair value. We do take into account your repairs, and what we're ultimately looking at is to make sure you're going to make a reasonable profit. So just because you're under contract, just because you can bring the 10% down, just because you have the money potentially to self-fund the repairs, doesn't mean you should do the deal. And so we'll have if it feels close or thin, we'll have a very honest conversation. We'll go through all the numbers. Have a big deal review kind of email chain or conversation where we'll pencil out all the numbers and really make sure that the way we analyze deals and then the way we crunch numbers, both as a hard money lender and our personal business, that you're looking at the same way. We're all on the same page as to, okay, here's the profit. Should we move forward or should we not? So it's not necessarily a loan to value, but we do want to make sure that just because you can qualify, that you should be doing the deal. And similarly, we'll do the same thing with the rehab loan. Again, we're maxed out on the loan at 70% of the ARV. But again, just because you have the money to bring the difference to closing and still have the reserves to qualify does not necessarily mean you should be doing the deal. And so that's something that we'll look at and we'll certainly chat about to make sure everybody's on the same page with should or should we not be doing this project. Can you touch a bit more on the 100% financing for rentals? Yeah, absolutely. I'd love to. So 100% financing for rentals, you're buying a distressed asset, something similar to a potential fix and flip where the house needs some repairs, broken windows, needs paint, carpet, a new roof, whatever those same symptoms are. But instead of wanting to sell it for the profit, you're wanting to hold it long-term as a rental property. So you're approaching the project from a somewhat similar stance. I'm going to buy it, I'm going to fix it, I'm going to increase the value of the property. And then what I'm going to do is use that new value to help qualify for the refinance. So our rehab loan is really the best fit on that because we're going to lend potentially 100%. So you're going to have very little to no money out of pocket, purchase, repairs, and closing costs, right? You're going to borrow that money. So we'll go up to 70% of the ARV. You buy it, you fix it. Now you're ready to refinance it. Maybe you have a tenant in place, or maybe you're just getting it ready, to market for a tenant, and then you call up your refinance lender. And so these lenders are typically Fannie Mae direct lenders for a couple of reasons. One, Fannie Mae direct lenders, which is a conventional loan, they do not have any seasoning requirements. And seasoning, of course, is how long you have to hold the property before you can refinance. And so if they don't have any seasoning requirements, then you could be refinancing potentially right away. The only real seasoning, if you even want to call it that, or delay in the refinance, is they want to see that new as is value. When they have their appraiser go through the property, they want to see the property fully fixed up. So the only delay in the refinance might be how long does it take to get the repairs done, right? If it's a quick paint carpet $10,000 deal, maybe you're refinancing within the first month. Maybe you're not even cutting a check to the hard money lender. If it's a full gut and remodel, 60, 80, 100,000, well, maybe that takes 3, 4, 5 months, maybe 8 months. But knowing that up front and planning for all that can be really important there. But that's kind of how that looks. And so with that, another reason we like those Fannie Mae direct lenders is they will lend up to 75% of that ARV, or in that case, the new as is value. And so if, say, my appraisal on the front end and the refinance appraisal, say, is both of the same value, I will have lent 70%, and then the refinance lender will lend 75%. So if my 70% will cover the purchase, repairs, and closing costs, meaning you have no money out of pocket at closing, buying with the hard money. And then at the refinance, their value comes in the same, and they can loan more than me, 75%. That would pay us as the hard money lender off in full. And that other 5%, although it's not a cash out refinance, you don't get to walk away with cash. This is called a rate and term refinance. What they are allowed to do is roll in the closing costs of the refinance. And so if they can do that, potentially, if you find a good deal, which is not necessarily the easiest thing to do, but if you find a good deal, you can have no money down at closing when you're buying with the hard money lender and no money out of pocket at the refinance. Yes, there's always a chance that depending on your hold time that you'll have some money out of pocket in monthly payments, but that is roughly how the 100% financing for rentals looks and is structured. And of course, if you want more on that, we've got other webinars we've done. We've got other videos on our YouTube page. I'd love it if you all went to our YouTube page. It's Pine Financial is the name of our page. Checked out all the other videos. We put out weekly educational videos on our YouTube page. And one of our yearly goals is actually to increase our subscribers. So if you could go ahead and go to our YouTube page and subscribe to Pine Financial's YouTube page, I would really love it. Love to see an uptick from the webinar. And then also you'll just be up to date on a lot of education that we do. Hopefully having a lot of other questions answered. And it'll help us get to our goals for the year. But along those lines, if you want some other information, we've got a special report on buying rentals with little to no money down. And I think we've got a video on our website that dives a little bit more into it. So there are lots of places. Feel free and reach out to me. I'm happy to chat with you more and dive a little deeper into that scenario. And of course, when we talk about it, we say little to no money because sometimes it's not no money down, but even a little money down is potentially a lot less than going other routes. So certainly something to be looking at, and I highly encourage you, if you're interested in rentals and you're not scared away by fixing up properties, certainly something to be looking into. Do we lend in Maryland? Unfortunately, right now we do not. So that is one of the reasons I put together this question. Of course, a lot of the folks that are listening are in Colorado and Minnesota, and so we do lend to them. So that's why I answered a lot of the questions, but I still think there's a lot of value in these questions. So unfortunately, we don't lend in Maryland, but I think this would be a good script, if you will, when you're talking to other hard money lenders. How long is a pre-approval good for? Now that is a great question because every lender probably looks at that a little bit differently. So for us, it's once you're in our system and pre-approved, you're pre-approved basically for forever, provided nothing materially changes. Once you're pre-approved, we hope your situation continues to improve, if you will, and thus you'll always be pre-approved. Now for us, our lender letters are also kind of always good, but real estate agents probably have a lifetime of 3 months or so on pre-approval letters. So if you were to get one today and then you're making an offer and trying to use the same one in December, there may be some questions. They may want an updated pre-approval letter, which is totally fine. We're happy to write updated pre-approval letters as often as you may potentially need. And of course, to be talking to those real estate agents and help you get something under contract. So once you fill out the application with us, you only have to fill it out once. We'll have it on file. And then as you get a deal under contract, if you get a second deal, a 10th deal under contract, then we just update the application on our side. You don't have to fill out the application each time. And so along those lines, do you pull credit each time once we are established with you? Yes and no. So for us, a credit report is probably good for 3 months. So again, if you did a deal with us today and we closed in June, I'll pull your credit. And then if the next deal you do is in December, I'll have to pull your credit again. But if you get into a good rhythm and you're doing a deal a month, no, I'm not going to pull your credit. If I pulled it today in June, I'm not going to pull it again in July. All right, is there anything else? These are some great questions, and thank you everyone for sticking on with me here. There's a long question here. I'm reading through it. All right. Well, thanks, Dave. Appreciate the feedback there. All right. So Keith wants to know how it would work if you want to partner with someone in your initial purchase. Would we both need to be on the documentation, be on the loan? Would the finances need to be secured by both of us, or could one of us have the finances and the other, and it kind of trails off. There it is. And the other be there in name only. So it depends. It's not the best answer, but without knowing you or your partner or the deal size or anything like that, it depends. The first time we work with somebody, really almost any time, the more the merrier, because the more people signing on the loan and being part of the transaction, the more reserves and liquidity we see. And ultimately, when we're looking at approving an actual deal, obviously the deal has to be a deal, not just a property you're buying. But liquidity is the thing we really focus on the most at Pine Financial when it comes to approving or pre-approving somebody. And so the more borrowers, typically, the more reserves you have. And so that would always help the case. Now, if one of the borrowers is just super strong, and because of that, you don't necessarily need the other partner to sign, even though that's the way the business is structured, is there's partners, then yeah, one of them could sign and that would probably be okay. Something else to think about is in the business, what's the ownership percentage? Keith, if you own 60% and your partner is 40%, and Keith is designated in the operating agreement as the manager, and thus he has the signing abilities and he can do all these things, then that would be fine. Keith can potentially do the deal all on his own. But if you're 50-50 partners, we want to make sure that everybody that's required to sign on the deal does sign on the deal. And so that's something to think about when it comes to structuring your partnerships as well as your deals. And then, so back to, I hope that answered your question there, Keith. And then back to the credit. If we pull it every 3 months, is it a hard pull each time? Well, I don't pull it every 3 months. If you're doing enough deals consistently, then yes, it would be every three months. And yes, it would be a hard pull. In my experience, it really doesn't damage your credit if you have one person pulling your credit every 3 months. You may take a couple point dip or something like that. And I know some people are certainly worried about that because a lot of people work really hard to get their credit where it is. But if you're just getting pre-approved or something with us, we're not going to pull your credit. We're going to take you on your word. There's certain questions on the application that you're saying if you have any issues or we should have any concerns with. So we're not going to pull your credit, and we're not going to pull it until you're actually under contract and moving forward with a deal. We all agree, yes, we're going to move forward. Pine Financial should be funding it. Let's get going on the diligence. That's when we'll pull it. And again, if you do a deal today and you don't do another one until 2021, I will not have pulled your credit again. I'll have pulled it that one time for that one deal. So I hope that answers your question there. And I don't see any other questions. So we are just a few minutes over our 1 hour time. There's been some great questions, and here is one more. Is it just a rehab loan needed to buy a house and rehab it, or does it also need the acquisition? That's a great question. So the rehab loan, with the rehab loan, what we want to do is cover 100% of the purchase price and 100% of the repairs. So if we're looking at moving forward with the rehab loan, that is just one loan that should cover the purchase and repairs. If, say, you have $50,000, $100,000 in the bank, and so you have enough to put 10% down and enough to pay for the rehab out of your own pocket, then that's when the acquisition loan makes more sense. If you're not planning on doing, a deal a month, you're doing one at a time, and you have enough to cover the repairs out of your own pocket, that's when maybe the acquisition loan makes more sense. If you have partners, or sometimes people will raise private money and not enough to cover the full $400,000 purchase price, but maybe they've got enough to cover the $30,000 in repairs, and they have some money in the bank. Then again, maybe that is when a client may want to do the acquisition loan. And so part of our conversation is when I talk to a client is which one's better for you, and then which one is better for the deal. And then ultimately it's up to the client to decide if they're eligible for both. It's up to the client, the borrower, the investor, to decide which one is going to be a better fit for them. So, but no, it's one or the other. It's not both. All right, last questions. Going once, going twice. All right, everyone. Well, thank you so much for spending your time with me. I really appreciate it. If you want a copy of this, I don't necessarily have a fancy form, but I'm happy to send you a list of these, in kind of a different format, so you can take a look and use this if and when you call other hard money lenders. Now, of course, I hope you don't, especially in Colorado and Minnesota. But I do understand if you want to shop around. So feel free and reach out. I'm happy to email it to you. My email address is on the screen. If you want to chat more about anything, like your specific situations or review a deal, feel free and give me a call. And of course, I am also taking on some coaching and consulting clients. So if you're at all interested in a little extra hand holding above and beyond just the hard money world, happy to help with that too. Reach out anytime. Thank you, everybody. Appreciate your time. Have a great night, and we'll see you next month.